Gold just did something it hasn't done in decades. It exploded. Record highs, headlines every week, your neighbor suddenly an expert on ounces and premiums. And then, almost overnight, it stopped. No more wild swings. No more red arrows crashing across your screen at 9:31 in the morning. Just flat. Quiet. The kind of quiet that makes seasoned traders nervous instead of relieved. Here's the question. Nobody's asking loud enough. Why would the single most volatile asset on the planet suddenly go dead silent right after its biggest run in a generation? Markets don't go quiet because nothing's happening. They go quiet because something is loading. Silence isn't peace. It's pressure. It's a coiled spring, wound tight, waiting for one signal to let go. So what is gold waiting for? And when it finally moves, which way does it break? Here's what we're unpacking. A record high that stunned even the bulls, then a brutal correction that wiped out nearly a third of the gain. A technical signal, buried in the charts, showing volatility hasn't been this compressed in months. A quiet accumulation happening in the background while retail investors look the other way, distracted by the calm. And a date circled on institutional calendars, a data release that could be the spark this whole setup has been waiting for. 4 forces, one outcome. Right now, they're locked in a standoff, and standoffs don't last. One of them is about to win, and when it does, this market will not stay quiet. But first, let's rewind. Let's talk about how loud this market used to be. Quick pause before we dig in. If you're new here, this channel exists for one reason. We track what actually moves metals, not the hype cycles everyone else is chasing. No panic headlines, no recycled talking points, just the signals underneath the price. If that's your kind of channel, hit subscribe, and while you're at it, drop your prediction in the comments. Breakout or breakdown, we'll come back to that. Now let's get into how loud this gold market really was. Let's start with the number that started all of this. In late January 2026, gold hit a record near $5,598 an ounce. Not a slow grind higher, a sprint, month after month of new highs. The kind of run that gets talked about at dinner tables, not just trading desks. Then came the reversal. From that peak, gold shed roughly 28%, dragging the price down into the $4,000 to $4,400 range by August. Read that number again, 28%. That's not a dip. That's the kind of drawdown that would normally dominate headlines for weeks. And yet, here's the part almost nobody frames correctly. Even after that correction, gold is still up double digits year over year. This isn't a collapse. It's not the top falling out of the market. It's a compression, a violent run higher, followed by an equally violent cooling off, both happening inside a longer uptrend that's still technically intact. But the price action alone isn't the real story. The real story is underneath it, in the volatility itself. There's a technical signal called the Bollinger Band Width Percentile. Think of it as a gauge for how tightly a market is coiled. Right now, that gauge is reading levels we haven't seen in months. Gold's volatility hasn't just cooled down. It's compressed to some of its tightest readings of the entire year. And this matters because history is not subtle about what happens next. Every time this kind of squeeze has shown up before, it hasn't led to more calm. It's led to expansion, a sharp, decisive move, breaking hard in one direction or the other. The tighter the coil, the more violent the release tends to be. So think about where that leaves us. A record high, a 28% unwind, a market still up double digits for the year, and now, sitting on top of all of it, one of the tightest volatility readings gold has posted in months. The swings didn't fade out gradually. They stopped, almost like someone hit mute. So the real question isn't whether gold moves again. It's why it went quiet right now, and what changed underneath the surface to cause it. To understand why that's strange, you need to understand how this market used to behave. Gold volatility used to track the headlines in real time. A surprise Fed comment, a jobs report that missed expectations, an escalation overseas. Within hours, sometimes minutes, you'd see it in the price. Gold used to react like a live nerve, wired directly into every piece of breaking news. That just changed. Look at what's actually hit the tape recently. A July jobs report that didn't just miss, it missed badly. The kind of number that should rattle a market pricing and Fed decisions. Inflation cooling for a second straight month, easing pressure on rate expectations. And overseas, tension around the Strait of Hormuz still unresolved. Still a live risk to energy markets and, by extension, to inflation itself. Under the old rules, any one of these alone would have sent gold swinging. Together, they should have been enough to break the calm wide open. Instead, nothing, or close to it. The price absorbed the jobs miss, it absorbed the inflation print, it absorbed the geopolitical uncertainty, and it kept compressing instead of swinging, like the catalysts were hitting a wall instead of a wire. That's the divergence. The inputs that used to move this market instantly are firing, and the output, the price reaction, isn't showing up the way it always has. Here's the way to think about it. This isn't a market that's stopped caring about the news. It's a market holding its breath. It's absorbing catalyst after catalyst without releasing, because something bigger is still ahead of it, something the market considers more decisive than any single data point that's already landed. Individually, none of these events was the trigger. The market seems to already know that. Which raises the real question. If jobs data, inflation, and geopolitical risk weren't enough to break this thing open, what is everyone actually waiting for? Because this isn't just a story about Washington. Zoom out from the Fed for a second, and the picture gets a lot bigger. Start in the Middle East. The friction between the US and Iran hasn't resolved. It's stalled. Talk of reopening the Strait of Hormuz keeps surfacing and keeps failing to close, and that matters far beyond energy traders. A meaningful share of the world's oil moves through that stretch of water. Every time those negotiations stumble, it puts a floor under energy prices, and by extension, under inflation expectations. Gold feeds on exactly that kind of uncertainty. As long as Hormuz stays unresolved, there's a geopolitical bid sitting underneath this market that has nothing to do with any Fed meeting at all. Central banks were back in buying mode in May, with reported official sector purchases totaling a net 41 tons. Poland led with 18 tons, while China added 10 tons, with Uzbekistan and Kazakhstan also continuing to buy. That latest reported data reinforces the broader pattern. Central banks outside the US have been steady, persistent buyers of gold for years now, treating it less like a trade and more like a hedge against a world where dollar-based reserves feel less certain than they used to. That kind of buyer doesn't chase headlines. They accumulate quietly in the background while retail attention is somewhere else entirely. Now look at silver, because this is where the story escalates. If gold's round trip was dramatic, silver's was violent. Silver ran from around $40 an ounce up to roughly $116, a move so extreme it briefly turned casual observers into silver evangelists. And then it corrected hard, right alongside gold's own pullback. That's not a coincidence, and it's not two unrelated markets moving in parallel. It's the same underlying force, a global repricing of risk, showing up across the entire metals complex at once. When capital gets nervous about currencies, rates, and geopolitical stability all at the same time, it doesn't just move into gold, it moves into precious metals as a category, and silver, being the smaller, more volatile sibling, always swings harder in both directions. So this isn't a US jobs report story, it's not even primarily a Fed story, it's a global one. Middle East tensions, central bank behavior, and a violent silver round trip, all pointing at the same underlying shift happening simultaneously across markets most people still watch in isolation. And once you see it at that scale, the next question is obvious. Who's actually positioned on the other side of this? Because at this scale, it's not retail traders deciding where gold goes next. It's institutions. And right now, they're pulling in opposite directions at the same time, which is exactly why the price has gone so still. On one side, central banks. The latest reported data available shows central banks added a net 41 tons in May, led by Poland with 18 tons and China with 10 tons. More current August official sector tonnage has not yet been fully reported, so the latest confirmed figure is May. But the trend feeding into this period has been consistent. Central banks have remained net buyers of gold even as other corners of the market cooled. That's not a short-term trade. That's a strategic multi-year accumulation executed by institutions with no interest in chasing headlines or timing a bounce. On the other side, ETF investors, the retail and fund flow crowd that piled into gold on the way up, have reportedly been redeeming. The latest confirmed World Gold Council data showed global physically backed gold ETFs experienced $8.9 billion of outflows in June, with holdings falling by 74 tons to 4,047 tons. Global ETF flows were still positive by $8 billion for the first half of 2026, however, so the picture is not simply one of wholesale capitulation. Directionally, this is the classic pattern after a sharp correction. Some of the buyers who came in late are the first ones out, selling into weakness while the long-term holders stay put. Then there's the mining sector, sitting in the middle of the squeeze. After roughly a 27% drop in the metal's price over 6 months, miners like Kerr, Hecla, and AMGOLD are walking into earnings season with real margin pressure. Their cost structures don't move as fast as spot prices do, so a correction this size shows up directly on their balance sheets, and how they report it and guide forward becomes its own signal for where insiders think this is heading. And underneath all of it, the bond market is applying its own pressure. The 30-year Treasury yield has spiked to roughly 5.275%, reaching that level on July 31st. That number matters more than it sounds like it should because gold pays no yield at all. Every basis point higher on that 30-year makes holding gold a little more expensive in opportunity cost terms, a little harder to justify next to a bond now paying real, guaranteed income. Put it together and you get a standoff. Central banks accumulating, ETF holders retreating, miners squeezed and reporting in real time, bond yields raising the cost of holding the metal at all. Four major forces, each with real capital behind them, pulling against each other simultaneously. That tug of war is exactly what's compressing volatility. Nobody with real size is winning yet, but somebody will. So here's where this stops being an abstract chart pattern and starts being about you. If you're already holding gold or silver, you've lived through the wild swing up and the uncomfortable pullback that followed. And it's tempting, in a quiet stretch like this, to stop paying attention, to assume the calm means the story is over. It isn't. A squeeze this tight, sitting on top of everything we just walked through, means whatever position you're in right now is about to get tested. Not gradually, over months. Tested. And if you're sitting in cash, watching from the sidelines, waiting for the right moment to get in, understand what that quiet actually means for you. It's not a sign there's nothing happening. It's a sign the market is loading its next move, and loading moves tend to release fast once they go. Here's the uncomfortable truth about squeezes like this one. Most people don't react to them in advance. They react after. They watch the breakout happen, watch the first big candle print on the chart, and only then decide it's real enough to act on. By that point, the calm is gone, and so is the entry most people actually wanted. That's not a prediction about which direction this breaks. This isn't about telling you to buy or sell anything right now. It's about recognizing where you actually stand in this moment, invested in cash or somewhere in between, and being honest with yourself about whether you're prepared for this to move fast in either direction without much warning. The traders and institutions we just talked about aren't waiting for permission. They're positioned, watching the same signal you now understand. The only real question left is whether you'll be watching with them when it breaks, or reading about it after the fact, wondering where the calm went. So let's talk about the bigger machinery driving all of this. Because the squeeze itself is a symptom, not the root cause. The squeeze isn't happening in a vacuum. It's the symptom of something much bigger, reshaping how every asset class is trading right now, not just gold. Start with the Fed itself. Under Chair Kevin Warsh, the central bank has been deliberately offering less forward guidance than markets are used to. No more telegraphing the next move months in advance. No more soft hints dropped in speeches to soften the blow before it lands. That shift sounds subtle, but its effect is anything but. When a Fed stops signaling its intentions clearly, markets stop pricing in a gradual path. They start reacting violently to every single data point instead, because each release is now genuine new information, rather than confirmation of something already expected. That's what hyperreactive actually means in practice. Smaller inputs, bigger swings, less warning. Layer onto that a steepening yield curve. Short-term rates and long-term rates pulling apart usually signals one thing: the market repricing its expectations for growth, inflation, and policy all at once, often faster than the real economy can adjust to. And then there's energy. WTI crude has climbed sharply in recent weeks, and that's not a side note, it's a direct line back to inflation. Rising energy costs feed into everything from shipping to manufacturing to the price of groceries. Just as inflation looked like it might be cooling, energy is threatening to hand it right back. Reduced Fed guidance, a steepening curve, resurgent inflation risk from energy. Three separate pressure points all building at the same time, in a market already primed to overreact to whatever comes next. This is exactly the environment gold has historically existed for. It isn't just a trade, it's the pressure valve. When policy visibility drops and uncertainty spikes, capital doesn't just sit still waiting to find out what happens. It moves into the one asset that doesn't depend on any central bank keeping its word. So all of that pressure is building underneath a market that's already coiled as tight as it's been in months. Which raises the only question that actually matters now. When that coiled spring finally releases, which direction does it break? Let's get specific, because it's going to move isn't useful on its own. Here's what technicians are actually watching, and here's what each side of this looks like on a chart. The current bullish scenario centers on resistance around the $4,300 to $4,400 zone. Gold recently pushed above $4,400 before pulling back, while analysts continue to identify $4,300 as an important near-term support area. A clean break above the 4,400 area, and gold isn't just recovering, it's opening the door toward 4,500, a level JP Morgan has already forecast for Q4 2026. That would mark a decisive statement. The correction was noise, not a trend change, and the underlying uptrend from January is still very much alive. The bearish scenario is just as clearly defined. A daily close below roughly $3,900 would invalidate the bullish structure entirely. Below that, the next real support doesn't show up until around 3,550, with a deeper zone waiting near 3,300 to 3,400. That's not a small pullback. That's a meaningfully different market than the one most holders are positioned for right now. Two scenarios, two very different outcomes, and both are tied to specific dates already on the calendar. Watch the CPI print landing, August 12th. That's the next major inflation read, and given how sensitive this market has become to every data point, it has real potential to be the spark. Then watch the September FOMC meeting, the first real opportunity for the Fed to either confirm or break the market's current expectations in an environment where guidance is already scarcer than usual. Between now and then, this is what to actually watch. Not headlines, not hype, but these levels and these dates. The chart has already drawn the lines. The calendar has already set the clock. What's left is which side gold lands on when the pressure finally releases. This isn't just chart reading, it's grounded in what the people setting policy are actually saying. Fed Chair Kevin Warsh was direct on July 29th that there is no soft target for inflation and that the Fed remains committed to its 2% inflation goal. That matters here. A Fed chair unwilling to declare the inflation fight finished is a Fed chair who keeps optionality open, including the possibility of tightening further if conditions shift. On the institutional side, JP Morgan is the checkable source here, forecasting gold at $4,500 per ounce in Q4 2026, after lowering its Q3 forecast to $4,300. The bank also warned that risks to its forecast were skewed to the downside if the Federal Reserve moved toward earlier rate hikes. Two named checkable sources. Same underlying message: don't mistake the quiet for resolution. So let's put the whole picture back together. Gold hit a record high near $5,598 in January. Then came a 28% correction, pulling it back into the 4,000 to 4,400 range. Through all of that, volatility collapsed to some of its tightest readings in months. Major catalysts kept hitting: a bad jobs report, cooling inflation, unresolved tension in the Middle East, and none of them moved the price the way they used to. Underneath, institutions are pulling in opposite directions: central banks buying, ETF holders redeeming, miners squeezed, bond yields climbing. Layer on a Fed offering less guidance, a steepening yield curve, and resurgent energy prices, and you get two clear paths: a breakout toward 4,500 or a breakdown toward 3,500. The CPI print and the September Fed meeting decide which one we get. So we're back to the question we opened with: is this silence about to break up or down? You've now got everything the market itself is watching: the levels, the dates, the forces pulling in opposite directions. I've given you my read. Now I want yours. Drop your prediction in the comments. Break out above 4,400 or break down below 3,900. Let's see who calls it. If you don't want to miss the moment this actually breaks, hit subscribe now, because when that catalyst lands, we'll be back with the outcome and what it means next.